All right, let's get right into it. For months, you've probably felt it, right? The economy just feels weird. Things are happening that just don't seem to make any sense. Well, today we're going to go under the hood and look at the hidden engine that's been quietly powering the global markets for the last 30 years. And more importantly, why it seems to be breaking down right before our eyes.
I mean, if you've been pulling your hair out wondering why your mortgage rates refuse to budge, even when the Fed is talking about cutting, or why the stock market seems to have a complete panic attack every few months, you are not alone. You're feeling the symptoms of much bigger, much deeper issue at play. And here's the twist. The real answer, the root cause, isn't found with the Federal Reserve in Washington. Nope. It starts halfway across the world in Tokyo, with maybe the most boring financial asset on the planet, a Japanese government bond. And believe it or not, what's happening there is shaking the entire foundation of our financial world. To really get why this matters, we have to understand how Japan, almost by accident, became the financial engine for the rest of the globe. For decades, it was literally the world's ATM. So the story really kicks off way back in 1992, when Japan's enormous asset bubble just imploded. This started what everyone now calls the lost decades. For 30 years, think about that, the country had basically no growth, no inflation, and no one was getting a real raise. So to fight this deep freeze, the Bank of Japan did something radical. They slashed interest rates all the way to zero. And then later, they even introduced something called yield curve control, which basically put a hard cap on long-term rates to force money to stay cheap. Now, this world of ultra-cheap money gave birth to one of the most powerful and hidden forces in all of finance, the yen carry trade. It sounds super complicated, but the idea behind it is actually incredibly simple. It meant big investors could borrow money in Japan for practically nothing, and then go shopping for profits all over the world. Okay, let's make this super simple with the Bob the Investor example from our source material. So, Bob borrows a bunch of yen in Japan at, let's say, 0%. Then he immediately swaps that yen for US dollars and buys a US Treasury bond that pays him, say, 4%. He just pockets the difference, that spread, as pure profit. Now, imagine Bob isn't just one guy. Imagine Bob is the entire global financial system, doing this with trillions of dollars. And this was not some niche little strategy. This was a multi-trillion-dollar fire hose of cash that flooded into everything. US government debt, Silicon Valley tech stocks, London real estate, you name it. One source called it the duct tape holding the entire financial system together. For 3 decades, the world was essentially running on free, unlimited Japanese Wi-Fi. But here's the thing. That Wi-Fi signal is finally cutting out. The ATM is flashing insufficient funds. See, this entire global structure was built on one single, giant assumption, that Japanese interest rates would stay pinned to the floor forever. And in 2024, that assumption shattered. That's right, in 2024, for the first time in 17 years, the Bank of Japan actually raised interest rates. In an instant, borrowing in yen wasn't free anymore. The simple math that powered this global engine for 30 years was completely flipped upside down. The free money party was over. And this kicks off a massive process called repatriation. All those trillions of dollars that flowed out of Japan for decades, well, they're starting to rush back home. Japanese investors who used to gobble up US debt are now looking around and finding better deals in their own backyard. And this, right here, is where it really starts to impact your life. And hey, don't just take my word for it. As the legendary investor Ray Dalio says, the bond market is the absolute backbone of everything. Its interest rate is like the financial world's gravity. It determines the value of every other asset. And right now, that foundation is starting to crack. You see, everybody's eyes are glued to the Federal Reserve. But here's a secret. The Fed really only controls the very short-term interest rates. The long-term rates, the ones that actually set your mortgage, are driven by something way more powerful: raw supply and demand. And for decades, Japan was this huge, unstoppable force of demand for US debt. Just think about the chain reaction here. When one of the biggest buyers of your stuff suddenly walks away, what do you have to do? You have to raise the price, or in this case, the interest rate, to attract new buyers. And since mortgage rates are directly tied to those long-term rates, they stay stubbornly high. Then higher rates make a company's future profits worth less today, which pushes stock prices down. And of course, it gets more expensive for companies to borrow, which slows down the whole economy. Liquidity, the very oxygen the market breathes, starts getting thin. Okay, so that's the mechanical story of how the engine is seizing up. It's a story of plumbing and global capital flows. But one of our sources presents a very different and much darker perspective. They argue that this kind of systemic chaos isn't just an unfortunate accident. No, it's an opportunity. It's the perfect environment for a very specific playbook to be run by large financial institutions. And this viewpoint points to one key indicator, the S&P to gold ratio. It's a simple measure of how many ounces of gold it takes to buy the entire S&P 500. Now look at this chart. The ratio plunged right before the dot-com bust in 2000, and it plunged again right before the 2008 financial crisis. According to this source, the fact that it's so low and falling so fast right now is a massive red flag. In fact, according to this perspective, when this signal flashes, the big institutions run the exact same 6-step playbook every single time. The goal? A massive transfer of wealth from the public to them.
So here's the alleged playbook. Step 1. The signal flashes, and institutions quietly start selling stocks and buying up hard assets like gold. Step 2. They get the public to buy the dip, creating a story of confidence while they secretly offload their risk. Step 3 is crucial. They need a public narrative. Step 4, an external event, any event, gets blamed for a crash that was already baked in. Step 5, retail investors try to sell, but suddenly, all the big buyers are gone. It's a liquidity trap. And then, the final move, step 6, the institutions sweep back in, buying up those same assets from panicked sellers for pennies on the dollar.
Now, the absolute key to this entire alleged operation, the thing that makes the whole machine turn, is understanding step 5. It's a concept called exit liquidity. The source points to this just wild contrast between what they say and what they do. I mean, the public is being told, buy the dip, while internal data shows institutions are dumping stocks at the fastest rate in over a decade. They say the fundamentals are strong, while they're quietly shifting risk off their books. They say, we're giving you access to better investments, while, as this source alleges, they're trying to package up toxic assets and stick them in your 401k.
Which brings us right back to that term, exit liquidity. What is it? It's the pool of buyers that lets the smart, early investors sell their shares at the top and walk away with their profits. And according to this perspective, the whole buy the dip narrative is designed to do one thing: turn the general public into that pool of buyers, to turn you into their exit.
So you're probably asking, how do these two huge stories, this global financial engine sputtering out and this alleged secret playbook, how do they actually connect? Well, that connection is exactly what all the headlines are missing. And it's this. The systemic shock, the end of the yen carry trade, creates the perfect storm. It creates the fear, the chaos, and the volatility. One source put it perfectly. The massive leverage in the system is like gasoline waiting for a spark. The unwinding of the yen trade provides the chaotic environment, and, according to the other source, the institutional playbook is the match that lights it.
So at the end of the day, we're left with two very different ways to see what's happening, both pulled from our source material. On one hand, you have the mechanical view. This is just a natural, if painful, readjustment of global capital. The instability is just an unfortunate side effect of a big market correction. But the other viewpoint is that this is a deliberate playbook, that the instability isn't a side effect, it's a necessary ingredient for a cyclical, predictable, large-scale wealth transfer. And that really brings us to the final, critical question. Are we just watching the gears of a fantastically complex global machine grind, break down, and reset? Or are we watching a game being played by a set of rules that most of us don't even know exist? Is the system just broken, or is this, quite simply, how the game is played?